Hello, everybody. Good afternoon. Today is Thursday, June 6th, 10 after 4 Eastern. Is anybody out there? What's up? What's up? What's up? All right, let's jump in. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. I got out of Apple again today. I did get back into Snap, Pins, and Bank of America pretty light, so added those back in. I feel like something else is missing that I took out. I don't know. I'm light. 14 positions on. Capital usage here is for my overnight positions is really light for me right now. We'll see. Let's take a look at these technicals. All right, so how do we close today? S&P up about 0.5%, Q's up 1.2%, and IWM down 0.5%. So the theme of the day today was mean reversion of the mean reversion, right? We had seen, going over the daily charts really quick. I'll come back to the SPYs because the SPY chart's starting to look really interesting. We had seen the Qs get ahead of themselves. We had seen the IWM underperforming and unable to break out. At first, we had called for this break higher in tech stocks and the NASDAQ. That worked out really well. As it seemed like they were getting ahead of themselves, we started to call for mean reversion. We finally got it on Friday of last week. The move from the IWM was really crazy. Yesterday in particular was a really crazy day. I don't remember what the percentages were because I didn't do the afternoon meeting, but I feel like the Qs were up 1.5%, and the IWM was down 1.5%, something like that. It was like a really, really wild difference of one being green and one being negative. And then today, and that was mean reversion, right? That was the IWM catching up to the Qs. That was RSP catching up a little bit to SPYs, right? The equal weighted S&P has been dramatically underperforming the market cap weighted S&P because the leaders, it's been 7 stocks that have basically been leading this entire market up until Friday of last week when we finally got some breadth improvement. But what we had discussed was after a 2-day move in the IWM that was huge, they were starting to hit the point of kind of that dramatic extension away from the ADMA where we can usually begin to look for trades that are on the other side, that are in the other direction, which we had just been doing in the Qs, right? Had a great little 2-day short in the Qs from the May 30th to the 31st, liquidated that position, market bounced back, and then I think I started reshorting them on June 2nd, exited that position yesterday when the market finally ticked back into its equilibrium area. And then as the Qs finally ticked back into its equilibrium area, though there is room for it to pull deeper, the IWM had gotten pretty much to where the Qs had just been a few days earlier. They were just getting really extended to the upside. So today we got some mean reversion of the mean reversion, with the Qs being positive, the IWM being down 0.5%. The Russell still looks good. It's just extended, and it'll be less extended because of today's time correction. The ADMA will continue to catch up. So the market technicals here look dramatically bullish. Qs with an inside day, which is pretty interesting. Yesterday's trading session is pretty much a negative Maribozu that almost closed on lows. One of the ways in which a negative Maribozu can get negated is through an inside and up. So we'll see if today's positive price action in the IWM actually creates an inside and up that leads to a negation of that QQQ high, which could cause this market to take a whole nother leg. I've been of the viewpoint, we chatted a little bit about it in the morning meeting, and then during the day, I know Denver Steve was kind of asking me some stuff about it. I've been of the viewpoint that this time around, we might need a little bit further of a market correction through time or price than just the ADMA catching up, and that's specifically for 2 reasons. One is that spread between the 8 and 21 EMA has widened. That does matter. And 2 has just been the VIX. The VIX posted, just looking at you, Vixie here, another red day today. But was VVIX actually positive? Can someone confirm that for me? I don't have a VVIX chart. But if VVIX was positive or at least was stronger, we might be seeing a little continuation of that divergence. and we have really consistently actually seen the VVIX lead the VIX, which sometimes leads the market. VVIX closed almost on highs. Thanks for that, Tate. So, yeah, so we'll see. The spread between the 8 and 21 EMA in this market, the extension that does still exist in the IWM, VVIX being down, VIX being down 9 days in a row with VVIX actually closing on highs. Those are a bunch of warning signals to me. They're not warning signals of, hey, Derrick, it's time to turn really bearish and start, being short and looking for a full reversal. The technicals here are super, super bullish, but it's more of a signal to me of probably more patience is required this time around, which, it's not the answer that anybody wants, right? We always want the market to be extremely exciting all the time, but probably more patience is required this time around. We probably need the market to go sideways more than, again, just the ADMA catching up. Looking at the VVIX chart here that Pat just posted. Thanks for that, Pat. With all of that said, SPYs are starting to build out a beautiful technical bull flag at this point. Looks great. The ADMA is catching up. Most of the time you look at this type of chart and in another day or two you're looking for upside continuation. But again, I'm looking at these warning signals and they're telling me that I shouldn't be overly aggressive and that I should be a little bit more patient. So I'll continue to do that, continue to focus on relative strength and relative weakness, which has been a great theme for this past year so far and has paid us a lot, and continue to focus on names in play when we're able to get them, which that was the difficulty for me this morning. We had a flat market, so I don't have a gap. Gaps always give me an advantage. And daily chart technicals that still look extremely bullish, but to me I'm seeing signals that they need more time, which tells me to be patient, in conjunction with just not a lot of names in play this morning that I found exciting. The few earning stocks, the upgrades and downgrades weren't exciting to me at all. I thought maybe I could try to lean into the news out of China that the government there is trying to basically provide stimulus for car manufacturers, get people to get out there and buy more cars, but that was kind of a dud of a trade. So not too much to do from a market-related perspective, though. We did have these SPYs and Qs go, and the SPYs in particular went much higher than I expected that they could. After a candle like yesterday, though yesterday was more of a rest candle for the SPYs, more of a negative Maribozu for the Qs, to almost fully retrace that for the SPYs is very impressive. It shows that strength. It shows that even as we're getting rotation happening from tech to mid caps and small caps, that the S&P itself is kind of the constant beneficiary of that. And the Qs bounced pretty well also. What would we feel like? 50% or so of yesterday's candle with an inside day today in the Qs. It's pretty decent. And then the IWM was relatively weak. I was able to short the IWM via purchasing TZA pre-market when the IWM was closer to 188. And for me, you got to be careful shorting. The market technicals are really bullish, but at certain periods of time when we have large upside extension in the market on the daily charts, then I will look the other way a little bit. I want to talk about that more with a second in a second, and talk about Carvana from today, maybe Palantir a little bit yesterday, because I know John Lee was asking me a question about Palantir, and then I had Josh take care of the afternoon meeting for me. But I really wanted that like $6, $7, $8 of extension in the IWM to be looking the other way. Anything less than that, I think, is too difficult. It's the market kind of more in no man's land. That's been a constant term I've been using. When the SPYs and Qs are extended away from the ADMA on the daily chart by like $6, $7, $8, that's really no man's land. I don't feel like I have an advantage long. I don't feel like I have an advantage short. For the IWM, if it's extended by like $4 or $5 from the ADMA on the daily chart, that's kind of no man's land, where I don't feel like I have an advantage short or long. But when the IWM starts getting to be $6, $7, $8 extended, then I feel like I have a stronger advantage on the short side. So this morning when we were able to get to 188 and kind of had like a pre-market red dog reversal to the downside kind of thing on the third day here, at that point I'm $6 plus extended on the daily chart. I feel confident coming in for that, but for me, I just took that trade early and that was it, and then made a few bucks, got out of the way of it, And then there were other spots here where it made sense to look for the IWM short if you were specifically looking at the IWM. The problem is that if you are then looking at the other indices at the same time, the SPYs and the Qs are so strong that there is a correlation there. And I've said this a lot in reverse. On days where we've seen the Qs be weak and the IWM be strong, I've said a lot. And yesterday was actually the first day that this was wrong. But almost on all other occasions, when the IWM has been strong and the Qs are weak and they sell off in the beginning of the day, there's no actual follow-through on that sell-off because the IWM is helping the whole market to be able to hold in at least to some degree, and you don't get any real continuation. Yesterday, actually, again, was the first example that we've seen in quite some time. I can't even remember, honestly, another time where that didn't play out, where the IWM was holding up great all day. And what we typically see is, all right, you get that opening weakness in the Qs are relatively weak. They could stay relatively weak all day, but they usually, that means that if you get this early sell-off, like this pivot low that happened at 1025 yesterday, a lot of times that's it. That's the low of the day. And it stays relatively weak, but it stays relatively weak by consolidating all day when the IWM stays strong. We kind of saw that in reverse today. So today, the IWM was weak early on. Had that upside extension on the daily chart, but you couldn't really get any follow through to the downside beyond that with the IWM while the SPYs and while the Qs were holding in so well. So took my IWM short early. Had the degree of extension that I was looking for, had kind of a day 3 up at a certain point today pre-market, though that eventually failed and came down by the time the market opened, and had that degree of daily extension where I feel a lot more confident putting that short on, and then I was out of the way on the trade pretty much for the rest of the day. So that was decent. Neo today was a disappointment. I ended up actually trading my way to be kind of break even in it, but it was just not what I was looking for, and I cheated. I said that in the morning meeting today, or even I typed it into the VTF even before the morning meeting. If you buy before the break of a level, you're cheating. That's what I call that. You're cheating on the level. And the thing about cheating on a level is that if it actually breaks, then you're going to have a much better risk reward. You're going to have a much more size. You'll make much more money. But if it doesn't break, then you'll take a loss on a trade that you never should have been involved in to begin with. So that's kind of the trade-off there. So I'll cheat on things sometimes, on stocks, sometimes on breakouts, like in this example, sometimes if I think that there's a catalyst there that could get the thing moving and get it above the level. And I thought there was, maybe honestly I was just reaching because there was just nothing I liked this morning. And even as I always do my absolute best to tell traders and tell our team when I think that the best advantage we have is to not trade, and that was kind of the message from this morning, it's still very hard, right? It's still very hard for me. In some ways the most difficult thing for a trader to do is not trade. But it's actually really important. When you don't have a strong advantage, cash is a position, capital preservation is important, risk management's the key to success in this business. Save your bullets, save your risk bullets for another day when we've got a stronger advantage. So, I don't know, maybe I was reaching a little bit with this Neo. I bought some pre-market at, 780 and change. And it just never cleared $8. It never went after it. And you could tell right away. If you waited for the market to open, first of all, it never broke 8. So for most people, you never got involved. But you could tell right away. This first bar was no good. Second bar, no good. There's no relatively high volume coming in, which is what you want to see in order for a thing to go. If you want to see what relatively high volume looks like, look at Carvana. This is what I wanted to see. Maybe not this extreme, because this is really extreme. But this is what I wanted to see in Neo. This is what you want to see in the names that you're taking if you're ever looking for continuation or momentum trades. Volume is a layer of probability. It's in my probability class, which I think is one of the most important classes I teach, so I always encourage people to go back to that one and kind of rewatch it. Volume's a layer of probability. How do you get a stock to go up 60% or whatever Carvana did? By having news and or volume. Volume creates and enables momentum. and a lot of times volume comes from the fact that there was a news event in a stock. So I guess since I got Carvana up, we could talk a little bit about trading Carvana today. We could talk a little bit about counter trend trading in general, between the IWM, the Palantir trade from yesterday that I didn't get to talk about, and the Carvana trade today. The first thing I want to say, and I want to emphasize, because I feel like I've been doing more counter trend trading recently than I usually do, but that's because the environment's been ripe for it. We've had that QQQ 10 plus extension on 2 occasions over the course of the last 6 days. We had that IWM getting to that $6 of extension, like kind of yesterday into today. Palantir yesterday, and by the way, judging extension on individual stocks is much more difficult from my experience than judging extension on an index. It's much easier for an individual stock, especially a growth name like a Palantir, like a Carvana, especially something that's got a large short float like Carvana. I mean, I've been very long Carvana since that last earnings report in early May. So for almost a month, I've been trading Carvana to the long side. I've been bullish technically and fundamentally on that stock ever since that report has come out. And then today I came in on the other side and I made money in it, but oh man, that was a really difficult trade. And like I said in the VTF, I did not make enough money in Carvana to justify the risk that I put on or the headache or the stress level that I put myself into to trade it. So again, just to reemphasize, even though I've been doing a lot more kind of counter trend stuff recently, I really think that this business is significantly easier to trade with trend. Like significantly easier. Those continuation trades, those with trend trades, those pivot lows within the trend where we have that setup that creates that pivot low continuation, whether it's a hammer continuation candlestick or it's an inside up, whatever it is. That's the easier trading. Significantly easier. So I want to start by referencing that. And especially if you're a newer trader and you're trying to learn the ropes, don't try to short Carvana. Don't try to short Palantir yesterday. I did really well with Palantir yesterday. It was my best name. That trading is so much more difficult. When you're going counter trend, actually this is a principle whether you're with trend or counter trend. You either need to be very, very light, in which case you can kind of give it a good amount of room and watch it, or as soon as you take size, you have to keep it very, very tight. And that's actually true regardless of the type of trade that you're taking. It's probably especially true in counter trend trades. And I said it in the morning meeting today. I was like, so I got out of my long into $20. $20 is a big resistance level. I caught a great move. I bought, Pat, again, shout out to Pat, shout out to Bill when he's here, shout out to anybody on the team who's getting news and information into the virtual trading floor. Pat just does such a fantastic job. I think I got stock at like $8.30 in Carvana on that earnings report day on May 5th off, the path to profitability. I did really, really well with this thing. Getting out into $20, it's over 100% move on the stock. And then even with that, I'm looking at this thing and I'm like, yeah, 20 is big resistance. This move is massive. I'm out. I got big extension here. I got more than what I was even looking for on this thing. And I'm potentially interested, I said in the meeting, in shorting this thing into this like 20 to 2050 kind of resistance zone if it gets up there. But the other thing I said was this thing could easily squeeze to $25 if it wants to today. The short float is high enough. The momentum that could come into a growth stock like this off that news, updated profitability on that news, you could easily get a squeeze to $25. And I specifically talked about it in the meeting. Like, I don't like the long. And I said I don't like the long as a new long. I don't even care if it goes to $25. I don't think it's a good trade. And I'll say that a lot. Just because something goes up and you were long does not mean that you did a good job trading. You could take a random person off the street who doesn't even know what a stock is and have them press buy and sell buttons, and they might buy a stock that goes up a lot. That's not anything special. what makes you money is what is how you approach the market, as far as consistency of a rules-based approach to trading and to everything that you do. That's what actually breeds consistency, and that's what we're looking for from traders. So, and that's not to say that you couldn't have found like a good intraday opportunity to get long. And I think a few of you guys did. I think somebody called out this pivot low at 10:05 with the ADMA catching up. Like, that's a good trade. For me personally, I don't like trading when I'm not supportive of the daily chart. So that's me personally. That's not to say that you can't make money on an extended stock on the daily chart by going long off of a 5-minute pattern. You absolutely can. But for me, for my approach, for my rule set, for my edge, if what I'm doing is not being supported by the daily chart, which I would argue that this is a great looking spot to buy based on a 5-minute chart, but you're in outer space on a daily chart, and if anything, you're buying somewhat close to a pretty big resistance level on the daily, which is this $20. That's just not my approach. And we do have people on the team. This is what makes the team so good, who have different trading approaches than I do, and who take trades like that, and who are successful taking trades like that. It's just not me. The short side of the trade was very, very difficult, and it did squeeze to above $25, which is exactly what I said it could do in the morning meeting if this thing starts to go, if it starts to break out. And you can even see here on the 5-minute chart how this $20 zone, which is daily chart resistance, actually acted as resistance during the day today. And this was actually the first short that I took. So I got out of my long pre-market at, in front of $20, did nothing with it all morning. When I saw, and I like doing this a lot, I did it on this trade here as well, and I did it on this trade here as well, and I've spoken about it to you guys recently. This is like a newer trade for me because I'm still getting better as a trader. That like 5-minute chart RDR that we've talked about in certain circumstances, where you have like that third bar to the upside on a 5-minute chart where it's getting extremely extended, and you kind of do like that RDR type trade, that red dog reversal or DOO trade, some of you guys call it, where you come in as a counter trend trade to basically look for retracement to equilibrium, not a reversal. It worked out well. So I'm like, all right, $20 is resistance. I just got these like 3 big up bars in a row here. Let me begin to short kind of with this 4th bar, and I was able to make a few bucks for myself, just looking for a move back to the ADMA more or less, and I got 100% out of the trade. And then $20, it broke out in a massive way, and that you could have taken this as a long here also, by the way. I saw that trade come in, didn't get involved, but for the intraday momentum traders on the team, breakout of $20 after a previous failure where you're not nearly as extended as you were before, that's a good trade. Amazing follow through off it. You get an instant move up to like 22 quarter or so. You get one 5-minute bar rest, correction, and then it shoots off again, taking another leg up. And it's the same trade. 1, 2, third bar, upside tail, 5-minute RDR, pull back to equilibrium. And that was the next trade that I took. The mistake that I made that definitely hurt me is getting back in on this trade. I find myself up money in this area. I kind of worked this range back and forth a little bit. I covered almost all of my short into equilibrium, not all of it. And then I even said, I think I said it here at 115, I was early. Once I saw that the 20 EMA was catching up to price and that this was going sideways, / the 15-minute ADMA was catching up to price, I think I said at about 115, wow, this Carvana might actually be setting up for another leg higher. And even saying that, I kept a small feeler position, and this is the dangers even of a small feeler position. Like I said in the beginning of the conversation, if you're doing this counter trend stuff or really with any trades, you can be small and give a lot of space, but if you're big, you got to keep it tight. So at this point, I covered the vast majority of my position. I'm very small. I got a few hundred shares left, something like that. But I rode that few hundred shares all the way against me from 22 to 26. And, again, it's a few hundred shares for me, for my position sizing. That's not a lot. But what's that? 300, 600, 900. It's $1,200 against me at highs. I'm like, oh man, like, you know, I got this thing $1,200 against me, and then I started trying to, you know, kind of work the short here a little bit, even though I didn't get exactly what I wanted, and I covered some into the 80 EMA, but I didn't cover all of it. I wanted a deeper move to the 21 EMA, and the next thing I know, you know, this thing's blasting off again, and I was heavier than I should have been at this point when it was breaking through 25, but I wasn't like insanely heavy. And at this point, I'm looking for the same thing. I'm looking for it ahead of time. I'm anticipating another one of these like 5-minute chart RDR price corrections coming in. And that's why I said, like, so I saw the first bar come in, gets up to 25. I see the second bar coming in. I'm like, all right, this thing looks like it's going to break 25. Pat said something, you know, very trader intelligent when he was on the radio earlier about how the higher these things go, the wider those ranges actually become. I don't. He said it great. He said it probably better than I can trying to repeat it. But like, what was you know, big 50-cent move down here becomes like a big dollar move that becomes like a big $2 move. That's kind of how these things work. So I'm watching this thing and I'm like, all right, and I'm trying to look at it, you know, ahead of time. I'm like, all right, like, big bar 1 here off this 80 EMA. This looks like a pivot low. It looks like we're continuing. Bar 2 here through $25. You know, what's that going to look like? What's the extension going to look like as I get into that third RDR on the 5-minute chart, basically, third type of that trade? And I'm like, probably into like 25.75 to like 26.25 is probably where I'll see it. And I think I typed into the chat, like, if I get this pop here through 25 to like 25.75, that's probably where I'll look to get like a lot heavier. And I did. And that's just such a hard trade. It's such a hard trade. The counter trend stuff is just so hard. Even in that circumstance, I have an idea of where this thing probably should be able to pivot back down. Like I'm saying, this is a pretty wide range for a $26 stock. 25.75 to like 26.25. Like, I'm gonna build into that, and like, you know, now down P&L on this thing, you know, despite having made money in this first trade, making money in the second trade, but between holding that few hundred shares against me, adding some here, not getting out of all of that, now I find myself like actually down in the name to the short side, and then really kind of getting heavy. And I took a big short at 25.74 and a big short at 25.99, and I had one other pretty big offer around 26.24, and then if it got above 26.24, I was gonna have to go into 100% damage control, find a way to be able to stop myself out of the position, and I was gonna be really pissed at myself for the amount of money that I allowed myself to lose in a very obvious short squeeze that I've been bullish on, that I've been long, that I know could go to 25, that I know has a very large short float. And the trade worked the way that it was supposed to. You know, I got filled 2 out of the 3 of those really large offers. You know, covered a boatload of stock just by the time it got to 25. Kept some for a little bit of a bigger move. I had a bid at 24.31, and then I was planning on upticking even more stock if I got filled to just about get out of the entire short at that point. I didn't get filled by 1 penny. Frustrating. We've all been there. You know, bounced back to 25.50. I re-shorted stock, but significantly lighter to see if I could get a lower high. I re-shorted like 25.24, 25.49, but again, not nearly with that size that I was taking in that initial pop, trying to get that lower high. Got that lower high, got the pullback I was looking for, liquidated my position into the close, made money in it, net made money short, but just like I said, not worth the aggravation, to be totally honest, not worth the stress, and the money that I ended up making in this thing was not worth it for the amount of risk that I put on, to be totally blunt about it. And that's in this circumstance, you know, like I was trying to think about it in the 10 minutes between the market closed and the afternoon meeting. I was really trying to ask myself, like, did you actually do a good job on this trade? And I actually don't know the answer to that. I got to think about it more, because I think I did some things really, really well with this trade, to be honest. And at the same time, I did some things really poorly. And there's just no room for me to trade poorly at all whatsoever. Um, so yeah, not great. It's very, very hard with these types of names, these short squeeze names, these momentum names, like what we saw with there was some chatter from Pat into the close about AMC and GameStop and what it was like living through that. I remember, AMC, that AMC short into all-time highs there. Whew, man, that was a scary one. That was a scary one. At one point, I ended up making pretty good money on it, and AMC ended up being my best short of the year by far. When all was said and done, I caught the move all the way down to, I don't remember, $20 or something like that, in AMC as a swing trade over time. But there was a point on that first day when it popped to 70 something where I was down a lot of money in AMC. So, the point is that this counter trend trading is just very, very hard. I did a much better job with Palantir yesterday. I was much more patient with Palantir. My sizing was much more appropriate. The spot on the daily chart was significantly more appropriate. I had more kind of volume confirmation really coming in at capitulation highs with maximizing volume here. This Carvana, and Pat kept noting it in the chat, even as Pat kept noting it in the chat, even as I was battling it short, and I totally agreed with him. And it just always seemed kind of too orderly on the upside. It was never really that upside capitulation, which I felt I saw more on the Palantir trade yesterday. But bottom line is I did make money in it. Probably not worth it. I did really well with Palantir yesterday. I've done really well with the QQQ shorting that I've done, which has been about 5 days of trading over the course of probably the last 7 or 8 on the short side of the Qs. Did fine on the IWM short. It wasn't big money. I didn't have big size, but I did fine with it. But the bottom line is that trading is so much more difficult than being with trends. The with trend stuff, and there's been so much of that before we got extended that we have been communicating as a group, whether it's in these indices specifically or a lot more with some of these individual names, some of these individual big tech stocks that we were involved in. I'm trying to remember, even looking at the chart, where some of the Amazon calls were that we had. I think like this Amazon pullback into like $100 support, and I think we looked at this breakout between the 9th and the 10th for continuation. That was like great. I think we called out another long after this price correction on the 16th. That was great. Then we had this time correction that led to another long call out, I think on the 26th. Like that was great. Over to Google, we called the breakout on this 108 for continuation, and this thing just exploded. Was a phenomenal trade. Meta, we called the break of 238. We called the base at 230. The break higher at 238. That was a great trade. Microsoft, same deal. I think we called out, and I wasn't involved in this one. We called out how tight this pattern got here off of this bull flag for continuation through there. There's been a lot of great calls in Apple on the way up. I mean, those trades, those types of trades are just, they're just so much less stressful and so much easier. I mean, even on Carvana, to the long side. If you missed that initial long, you had the long on the 30th that was called out. Some of these upside squeeze trades that we've been involved in, this lemonade off of this day, if anybody was in that. Or then we had the lemonade technical pullback pivot into $15, below $15. That was a long. Like these are all longs that worked great. There's been so many of them. And then we have like Pinterest, PayPal, even though I got pushed out of it. Some of you guys made money in it. So that stuff is just so much easier. It's so much easier. It's easier money. It's less stress. It's got better risk reward. It's got significantly best risk reward, especially if you're not afraid to swing trade. If you've got stuff that closes well in your favor and you keep a percentage of your position overnight. Like, I don't know, just going back to Google, like Google, if you got stock from 108, it closes at 112. You say, all right, I'm going to keep 20% of my original core position, and next thing you know, you are looking at this thing at 126.50 and saying, wow, I got in at 108, I'm $20 in the money. Should I get all out of the position? I got a lot of extension here and look to rebuy it for cash flow, or should I just keep some and endure a potential technical pullback to see if I can get higher prices? Like that type of risk reward you can't get really on the counter trend stuff. You know, what's my best bet on any, even Palantir? Like, I did really well with Palantir yesterday. Like, Pat was involved with me. Pat just looked for the pullback to equilibrium, and a lot of times that's just enough. That's a great trade. You know, probably out somewhere between the 8 and 21 EMA off of highs. Really good. I caught a bigger move because I was looking at where the daily chart was. So I liquidated at $15. Really great trade. But the reward is so much more limited on these things. You know, on Carvana today, what am I looking for? For all the stress I went for, what's my reward profile? Pull back to the space between the 8 and 21 EMA. And it worked. And I did it again, and it worked. And then I got caught. And then I did it again, and it worked. But you get caught that one time, and you know, you don't, especially if you don't manage risk well or your sizing is wrong, it like, the risk reward is just so much worse. And it's so much more difficult, and it's so much more stressful. The issue is that we can't tell the market what to do, right? Like, we can't tell the market what to do. I can't recreate the Amazon, Google setups that we had, the meta setups that we had. I can't just recreate those for you guys on a day-to-day basis because they're just not there, right? The market takes days, weeks, months to, you know, build out those types of setups. And it's really important that when they are there and when they do present themselves, that we take advantage of them. And other periods of time, and like I said with the morning meeting today, today's a hands-off type of day. So, you know, I'm still trying to make a living for myself. I'm still trying to create some cash flow for myself. And if all I've got is the QQQ $14 of extension short, the Palantir short, the Carvana short, then fine, I'll go after it a little bit. But I'm never going to be able to make the same degree of money. And I have made pretty good money shorting the T-triple-Qs over the course of 1, 2, 3, 4, 5, 6 out of the last 8 trading sessions. I was short the Qs, and I did pretty well with it. It was a nice little add-on into my P&L. But I'll never make the money there that I will, you know, being long the Qs on the breakout from 324, and I'm still long at 355. The big money in this business comes from capturing big moves on big size. And you can have big size and be counter trend, and you can make some bucks for yourself, but it's significantly more dangerous. And getting the really big moves off that, it's always reward limiting. So I think that's it. I think that's all I got. I'm supposed to have a hard cutoff at about 5 o'clock today, but we'll see what happens. Happy to answer any questions that you guys have. So scrolling up here in the VTF, first thing I'm seeing is from Kyle. Can you talk about some ways to get involved in Carvana to the long side? I think we did a bit. I tried the inside 5 early on in the day, but did not plan for a re-entry. Is this a situation where you want a game plan to try a few times? Like, if I get stopped out, maybe then look for continuation, hammer to re-enter. Sure. So I would start by saying the same thing that I said earlier, which is that just because Carvana went from, you know, $19 to $26 today, I don't necessarily think that that's a good long. For the way that I trade, for my approach to markets, I don't chase daily charts. So if you're showing me a $20 stock that has its ADMA at 16 and change and the stock's at 20, that degree of extension, for me personally, I'm very rarely going to have interest in being long that. I might do some fun, you know, day trade scalps once in a while on small risk just to try to create some cash flow and have some fun. But for the most part, that's not how I roll. That's not to say you can't make money doing it, and some people do. I know Sharir, I think, was involved. I know Judy, if Judy's listening, is a really good momentum trader. Always, you know, you always see her typing into the VTF like the things that for me, I look at it, I'm like, ooh, a little bit too extended for how I like to trade. Be a little bit careful with this name. And for her, she's like, I'm in, I'm out, my risk is covered, downside's really tight, scalped it, put some money in my pocket, moving on. And it's just not, it doesn't fit my personality to be able to trade that way. But again, it doesn't mean that you can't. So yeah, you got the one I pointed out was the continuation hammer with the ADMA catching up for the first time here at 10:05. I'm not going to be involved in that. But that's an example. It's the same continuation trades that we always talk about. You can look for your continuation hammers. You can look for your inside and up into the equilibrium zone. Those types of trades. You can look at for pure technical breakout even through 20. Those types of trades. So thanks, Kyle. From Charles. Always appreciate the room. You often speak about updating your spreadsheet daily with your trades. How are you tracking cost break even? When you have core swing positions on and also day trade the stock. I know you treat each core buy as a separate trade with its own P&L. Do you simply add, subtract the day trading P&L from the core? Yeah, basically, Charles. And then the question comes down to, and I think we spoke about this a little bit back when we were trying to be long PayPal. I think maybe Steve had asked that question, or somebody had asked a really insightful question. It might not have been Steve, actually. About like I made this money on the way up and I'm trading around that core position, which means I'm putting cash flow, which actually means that at a certain point my break-even price goes down. So one thing that you can do is, you could keep your original stop loss, and then when you get stopped out, you just made money. If it just continues to work, then you'll make even more. Another thing that you could do is, and I do this, is risk what you've made by actually lowering the stop loss consistent with what the break-even price is to continue to work that position for more and more cash flow. And that's what I did with PayPal. So I ended up giving back everything that I made in it. And that was my game plan. My game plan was to be willing to give back everything I made in it. Unfortunately, I got pushed out a little bit below lows. A couple of you other guys were able to stay involved. Chris, Pat, a few other people, and were able to capture the move that we were actually looking for up to $65. So that's a great job. But for me, risk management is always number one. My risk management rules forced me to liquidate that position. But yeah, and that's basically what I'm doing. I update my spreadsheet so my swing positions have a game plan around them. But that game plan is continuous because I'm not exiting the position. And I'm in, 10 to 25 plus positions at a time. I'm not going to remember the next morning exactly where I was with my game plan on every trade that I was in. So what I'm doing into the close every day, the last 15 minutes, is I'm updating where I am with my game plan. So that the next day I can just pick up right where I left off. And then after the afternoon meeting, I update a separate spreadsheet that adds on any cash flow trading that I was able to do that day and how much I was able to make. So hope that answers the question for you, Charles. Appreciate having you in the room as well. So keep it up. Keep up the questions. Bandit. Oh man, you guys are a real riot. You know that? You guys are hysterical. Let me see if there's anything here on YouTube, because otherwise I do have to jump soonish. There is. From Chris K. I notice you always sell some after the open, saying you got in during the pre-market. Do you have a system of where your stop is placed during the pre-market? So you can't have stops pre-market. You can't have physical stops pre-market. They don't work. I do have mental stops sometimes, especially if it's a brand new position. If it's a position that I was already swinging, then it could just be that my stock from yesterday I still have. Stock's gapping up. I'm selling some as per my game plan into the gap up. Otherwise, it's a position that I entered this morning. Like TZA was a position that I entered pre-market this morning. I didn't have a stop loss in TZA. I was light. I was planning on building in, and like I've discussed in the past, it's difficult for me sometimes because I want to provide truth to you guys on what I do, but I also want to tell you guys, honestly, what I think other people should do. And like what I do in certain circumstances, having, 1,000 shares in TZA with no stop loss, I can do that. For someone who's in a small account, who's entry level, it might be completely wrong for that person, and you could do a lot of damage to yourself. So, know what's appropriate for you for your own trading. For instance, I like to have a thesis on the day for overextended stocks on a daily chart. I want to get long short, but I have no idea where I should put a stop in, since the open can be so wild. Yeah, for sure. It goes back to what I was saying even earlier in the meeting. If you've got size, you've got to have the stop. And what size is various for everybody. For some people, 100 shares might be size, depending on the price of the stock. For other people, 10,000 shares is when you would say that you've got size. And if you just have 1,000 shares of TZA, like I said, you don't need to necessarily have that stop. You can afford to manage it. You can afford to watch it. You can afford to let that pivot come in and then have that become your stop a little bit after the fact. I do not recommend that for entry-level people. For entry-level people, if you're new to trading, you want to make sure that every trade you put in has that hard stop loss, and the second that you get into it, you can measure exactly how much money that you're going to lose if you're wrong, and measure how much money you can make if you're right. And I appreciate the compliment there as well, Chris K. Back over to the ETF to see if I missed anything in there. Otherwise, I will shut things down. From Dave S. With this Tesla latest news, this seems like the opening move that Tesla is making against big oil. Yeah, I don't know what's going on right now with Tesla because I'm doing the meeting and I'm not paying attention to what's happening. But I'm going to go back and look at it as soon as I'm able to. So it sounds like Tesla's making a move against big oil is what you're telling me, for lack of a better term. Any off-the-cuff reactions to this charging station news? Yeah, so I don't know what the news is yet. I see Josh posting some stuff. I got to go back and look at it. I mean, these arguments have been out there for a long time, and I've been on the side of these arguments, honestly, for a long time, because that's what the price action has showed us with these energy names. I left XLE for dead somewhere in my career. I don't remember where. This thing just stopped performing. It was just garbage compared to the rest of the market. The thesis to me was very obvious that, people are getting, renewables, they're putting solar panels on their homes, they're, getting electric cars, things like that, and that very, very, very slowly it could become a dying industry. But you got to think about oil from a global perspective, one, and how big the world is. You also have to think about that the people who control oil and make their livelihood off of it are generally not stupid people. You have OPEC Plus for a reason, that control output of oil to create prices at certain prices. And, if it's the Saudis are, cutting output to manipulate prices higher, because over time there becomes less demand, which, by the way, we're not seeing less demand yet. Maybe we're seeing a slowing of the acceleration of demand for oil, but we're not seeing less demand yet. But they can just control supply and demand. I mean, it's an oligopoly, right? It's made to be able to do that. And every time the Saudis say, hey, we're going to cut prices a little bit, well, Chevron and ExxonMobil and Oxy go up. And then the flip side, and we really saw this like the last year or two, is that because of that thought process, the stocks just got brutally cheap. And the other thing is that has gotten me excited more than anything else about like your Chevrons and your Exxons and your Oxys is I think that those stocks can go up regardless of the price of oil because they've just changed their business models. They've just gotten much more, I think, in a lot of ways, investor friendly with how they return cash to shareholders. I mean, look at Chevron's buyback. It's just what I keep pointing to. What is it, 10 billion a quarter or something like that? It's insane. It's insane. So they're not going anywhere. Over time, over a very, very long period of time, we can potentially see oil demand stabilize, maybe go down. But, you got to think about it from a global perspective also, not just like a U.S., European perspective. The demand for oil in Brazil and India and China and the populations that those places have aren't going anywhere. I mean, maybe to a certain degree over time, China, because it looks like they're trying to focus a little bit more on their renewable stuff and move away from coal. But that's a very, very, very long game. You know, I think we're talking about another 10, 30, 50 years. So for the moment, I'm still comfortable being long Chevron. Appreciate the question. I'll look into that news. I'm going to jump. Have a fantastic night, everybody. I'll see you all tomorrow.